Bank of America's latest warning that labor demand is crashing. I'm your host, Steven Van Metre, and thanks for joining me today. And Bank of America's analysts are warning that demand for new hires is tumbling as employers slash job openings as the economy slows. And tack on to that the Federal Reserve wants to see more Americans on the employment line. You can see that the labor market is going to be at the forefront of the next recession. Let's pick this story up where we head over to Bank of America's Global Research, who headlines that labor demand, there's chips in the foundation. They're not just chips, they're cracks. We continue to believe that the Fed will be hard-pressed to drive inflation down toward its 2% target without raising the unemployment rate meaningfully. To do that, it will likely require a significant downshift in labor demand. In this piece, we leverage job postings data from Relied Labs to gauge the latest trends in labor demand. Now, why would the Fed want that? Well, let's take a look at this chart before we get into the Bank of America piece. And we've got the unemployment rate in blue on the left side, and on the right, got the consumer price index on a year-over-year rate of change. Now, prior to the U.S. dollar becoming the reserve currency, I don't want to say before it became the reserve currency, before we figured out how to use it as a reserve currency, which really started occurring in the 1980s as outsourcing began, I want you to see what the relationship was between these two and then how it actually has changed. And then you'll get an idea of why the Fed wants to see a lot more Americans on the unemployment line. So here we can look back and notice that when inflation took up in the 70s, that would follow is the unemployment rate later. And then you can see again inflation going up, consumer price index rising, and then unemployment rate falling. Now it's a little bit different. You notice now as we figure out here in the 80s, outsourcing, how to use the dollar as a global reserve currency, what changes? Now you see inflation rising, and then unemployment starts to rise, and then inflation comes down. You see unemployment rise or inflation rising, then unemployment starts to rise and brings inflation down. You see that relationship here again. You see CPI rising and unemployment rate starts to rise. That brings inflation down. And why does that make a lot of sense? Is well, because people who aren't working tend to consume less, primarily because their wages are a lot lower. And so when we talk about how the Fed actually wants to see more people on the unemployment line, well, we heard that from Fed Chair Powell himself say that this is going to be a sacrifice, and part of that is going to be a rising unemployment rate. And now you understand why. But let's take a look further into this B of A report as Relied Labs data show that new job postings declined by roughly 2 million to 6.6 million in April. This was the lowest reading since September. The drop in new postings was broad-based across industries, with 146 of 147 industries registering a decline in new postings. And new job postings continue to exceed the number of voluntary job leavers, but the gap is narrowed, suggesting some cooling in the labor market. Now, why is this interesting? Is because when an employer has a lot of demand, so imagine, we'll use that taco truck example we've used so many times. And so let's say you're producing tacos, but the demand is just even more than you can handle. Well, what do you do to meet the demand? You hire more people, you make more tacos, you sell them to people. So you start posting job openings. And so as those openings go down, what it tells us is that employers are actually now meeting demand where they don't need quite as many employees, or that they're starting to see that demand is slowing down, and so they're scaling back on their need for future employees. And that's why this is a great indicator of where the economy is going and what demand is like. So job postings are a good gauge of unfilled labor demand. The official government source is the JOLTS, the Job Opening Labor Turnover Survey from the BLS. As of March, the latest available data, there were a record 11.5 million total job postings, nearly double the number of unemployed persons. The drawback of the JOLTS, however, is the data is lagged, and in the current environment, changes can happen quickly. Now, keep in mind that the data we're looking at from Relied, the government's never going to use that. They use their own data from their own people, and it's lagged, and you can see why is because they don't have real-time data. But here's what the Fed is looking at. And now remember, this was former Fed Chair Janet Yellen's favorite. She said, my favorite economic indicator is the JOLTS. There's currently 11.5 million job openings. And of course, we know that Fed Chair Powell studied under her. He was on the board under her. And you imagine this is one of his top metrics as well. And he's mentioned it in several press conferences. But you can see going into recessions, the number of job openings declines. It doesn't go negative. There's always job openings. They're just harder to come by. You can see that going into the great financial crisis, they slowed. You can see when we almost had a double dip or a second recession in 2015, 2016, you see job openings started to stagnate and then decline going into the pandemic, which perhaps starved off a recession. Now the Fed sees all of this demand, but Revilio says, well, hold on tight. We therefore leverage data from Revilio Labs on job postings to get a better sense of incremental labor demand in real time. Unlike JOLTS, Revilio measures new instead of total job postings. Nevertheless, it tracks total job postings closely with a correlation of 93%. In April, new job postings fell by 2 million to 6.6, according to Revilio's data. This is the largest monthly drop in the available history going back to May 2019. In addition, the decline was broad-based and recording a month-over-month decline in new postings. Moreover, the share of industries with a year-over-year decline in new postings rose 22.5%, the highest since February. In short, the drop in postings could be a sign that labor demand is beginning to cool, and as labor demand starts to slow, well, so too is the economy. Aside from the Revilio data, there are other signs of moderating labor demand. The share of businesses planning to increase employment in the NFIB Small Business Survey has fallen by 8% since December 21 to 20% in April. The Challenger job cuts are 8 points to 20% in April. Challenger job cuts, these are from large employers, increased by 6% year over year in April, the first increase in 15 months. And anecdotal evidence is also building with the likes of Amazon, Facebook, Walmart, Target, and Netflix, all recently giving negative guidance on employment. And nonetheless, it's important to note that labor demand remains red hot. The number of voluntary job leavers, a count of quits and other separations from JOLTS, as we note that exclude layoffs because they are least likely of job separations result in new job postings. When new postings are roughly equal to voluntary leavers, then postings may simply be replacing newly opened positions. However, when new postings exceed job leavers, that suggests new positions are being created, which has been the case for the last 15 months. And so now you get an even bigger idea of why the Fed wants to scale back the economy, why they want to tighten things up. They want to see people hit the unemployment line. They want to see the JOLT survey, which is all they're paying attention to, go down. And what Revilio is telling us is, well, the JOLT survey is coming down a lot. But that's not going to stop the Fed. If that's what you're thinking, not going to happen. The gap between new postings and voluntary separations will likely narrow when we get the April data from JOLTS, but it's unlikely to close completely. The upshot is that we will need to see new job postings fall much further in order to cool down the labor market and subsequently wage and price increases. As Fed Chair Powell put at the Wall Street Journal conference earlier this week, quote, the Fed clearly has a job to do on cooling demand. And here you can see from this new postings of the Revilio jobs versus JOLTS quits, you can see they have a nice correlation suggesting that we can expect in a future JOLTS survey that red yellow line is going to head lower. But yet the government is all behind on the Fed tightening, and I want you to see what's coming out of the White House, what their advisors are saying, because they are 100% behind the Fed. They know that more people are going to hit the unemployment line, and they're not concerned about it at all. As Biden advisor says, the U.S. economy can withstand Fed inflation fight. Deese, the director of National Economic Council, said that approach reflects President Joe Biden's pledge to make reining in the biggest consumer price increases in 4 decades his top priority. We need to give the Fed the space and the independence to do its job, which is to get inflation under control. There's always risk, he said, and when asked where the U.S. is headed for a recession. There's always risk, he said, when asked whether the U.S. is headed for a recession. He said the U.S. economy is in transition to a more stable and resilient growth. Now, keep in mind, they think the economy is in super strong shape and can handle any minor pullback or just a throttling of demand to whatever the right level is. I want you to understand that this is what policymakers, not only the White House, the Fed, everybody else thinks is what is going on. They think the economy is very strong. And while there are absolutely risks with inflation first and foremost, this is what is most important. The United States is better positioned than any other major economy to bring inflation down and address these challenges without giving up all the economic gains we've made because of the strength of our recovery. And one of the things that course, these policymakers can't see. We have this chart from Cross-Border Capital is showing global liquidity, a topic we talk about on the show, and I talk about how liquidity is being drained as the Fed tightens monetary policy, and their projections here in orange as you see global liquidity, and that means wealth is coming down, and that means, of course, stock markets around the world are coming down. And if you're concerned about what tighter monetary policy, rising unemployment, and a lack of liquidity means for your portfolio, well, you shouldn't be. Portfolio Shield's done a great job here recently of containing risk. If you're not familiar with it, I'll put a link up here in the corner and the description below, because, well, conditions are ripe for a deep bear market, as a risk is a series of bear market rallies that don't last, hurting dip buyers and further damaging investor confidence. With the S&P 500 briefly on Friday down 20%, which is about where a bear market begins, it's very tempting to start trying to call the end of the sell-off. The problem is that only one of the conditions for a rally is in place, and that everyone's scared. That worked beautifully for timing the start of a 2020 rebound, but this time around may not be enough. Of course, with liquidity draining, we can see that. The other requirements are that investors start to see a way through the challenges and that policymakers start to help. But without those, the risk is a series of bear market rallies that don't last, hurting dip buyers and further damaging investor confidence. And of course, at a time we know the Fed has said, and they've been very clear, that the market will need to reprice. They're telling you right now, up front, stocks are going to go down, and we are okay with it. But investors, you hear them say, don't fight the Fed. Well, on the way up, they don't fight the Fed. On the way down, they're fighting the Fed. They think, they believe if market goes down enough, Fed will break. Not this time. Not this time at all. And confidence is already weak, as surveys of sentiment show. Fund managers surveyed by Bank of America, private investors, and financial newsletters are already at March 2020 levels of caution about stocks. Options that protect against market falls haven't been so popular since back then either. And consumer sentiment, as measured by the University of Michigan, which we cover regularly on the show, is actually worse than it was then. In 2020, that wasn't up because central bankers and politicians were frightened too when they stepped in and helped investors see that with government support, companies could make it through. But there's nothing magical about a fall of 20%, the usual definition of bear market, but it does crop up a lot. And in past 40 years, the S&P 500 has bottomed out with a 20% or so peak to trough decline 4 times in 1990, 1998, 2011, and 2018. Another 4 times it had far bigger losses as true panic took hold. The common factor in the 20% drops was the Federal Reserve. Each time the market bottomed out when the central bank eased monetary policy, with the stock market's fall perhaps pushing the Fed to take the threats seriously. And I want you to understand that this time the Fed has literally just sat back, watched the market fall, because they know, as I've shown you, we talked about this last week and looked at charts, the demand will go down as the market goes down. But one thing that does look good is the Chicago Fed National Activity Index, which suggests the economy is indeed growing and can handle perhaps a pullback in growth, as the Chicago Fed National Activity Index increased to 0.47 from April from 0.36 in March. All 4 broad categories of indicators used to construct the index made positive contributions in April, and all 3 categories improved from March. And the 3-month moving average, which is a great gauge of future inflation, ticked down to 0.8 in April from 0.49. It has to be over 0.7 sustainably to have inflation be a problem. Production-related indicators contributed to plus 2.6 of the CNFAI in April, up slightly from plus 0.2 in March. Industrial production increased 1.1% in April. The contribution of the sales, orders, and inventories category to the index edged up to 0.04 in April from a negative the previous month. Employment-related indicators, which we can now suggest in the future are going to go down, contributed to plus 0.1 to the index, down from plus 0.17 in March. The unemployment rate was unchanged at 3.6% in April, and likely to go higher. And yet, on balance, employment-related indicators weakened slightly from March. The contribution of personal consumption to housing category moved up 0.08. And with that, you can see when this thing is at 0, it's at trend. So the economy is growing above trend, giving you every indication that the Fed can tighten monetary policy, pull back the reins, bring stock prices down, raise unemployment, and not cause any problems. Well, as history shows, they'll probably be wrong, and probably be wrong in a big way. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.